What is up, guys? To recap, we have discussed about what bond is and 3 different types of bonds in the previous episode. Today, the focus of my presentation is to give you a better understanding of bonds as followed. First, characteristic of bond. Second, the difference between bond and stock. Finally, risk of bond. As we discussed in the previous episode, a bond is simply a loan given to a company or government by an investor. The investor received regular interest payments and the return of the original investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a more predictable and stable form of investing. Here we have the chart that shows the price change of TLT, 20 years Treasury stock shown in red, and Intel stock shown in blue. When we compare regular payments of a bond to the experience of owning a stock, with stocks, profits and losses are driven by market forces and generally less predictable. Of course, like any investment, bonds are not without risk. First, one risk that bond investors face is the possibility that the issuer defaults on paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk also come with higher coupon rates. The amount of risk depends mostly on the financial stability of the issuer. For example, most governments are generally considered stable issuers and issue bonds with a relatively low coupon rate. Corporate bonds typically represent a greater risk of default as companies can and do go bankrupt. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies assign rankings to different bonds. This can help bond investors to gauge the financial strength of the bond issuer. These rating agencies often use different criteria for measuring risk, so it's a good idea to compare ratings and considering a particular bond. And keep in mind, rating agencies aren't always accurate, so be sure to research a bond and its risk thoroughly before investing. Another risk to consider is interest rate risk. This is the risk that interest rates will go up and any bonds you own will be worth less if sold before the maturity date. After all, when interest rates rise, more investors allocate their money into the new, higher interest rate bonds. If you wanted to upload a low interest rate bond to take advantage of these new rates, you would have to sell our bond at a discount to make it a worthwhile purchase for another investor. Many investors use a mix of stocks and bonds to pursue their investment goals. And because bonds move differently from stocks, they can help increase or protect portfolio returns. Likewise, I've included TLT in my portfolio in the previous episode. In addition, I also include SLV Silver ETF in my portfolio to protect portfolio returns. Today, I've discussed about bond in detail. Next time, what I'm going to do is to discuss about capital gains taxes. Hope you guys enjoyed today's video and you're gonna show me some love by smashing thumbs up button and leave me a comment down there on your opinions. See ya!